Hello traders and welcome back to the Forex Geek. In today's video we're going to dive deep into one of the most essential aspects of technical analysis. We're going to be talking about bullish continuation candlestick patterns. So these patterns are crucial for identifying when an uptrend is likely to continue after a brief pause or consolidation. So by understanding these formations, you can make more informed decisions. You can optimize your entry points and manage your trades with greater confidence. So stick around until the end of this video to learn how to spot these powerful patterns and use them effectively in your trading strategy. So without wasting much of your time, let's get started. So what are bullish continuation candlestick patterns? These patterns are specific formations that occur during an uptrend, such as this one. This is an uptrend right here. And these patterns form during an uptrend, signaling that the market is likely to continue moving higher after a brief period of consolidation or a minor pullback. So these patterns are essential for traders because they help confirm that the current bullish momentum is still intact, even if the price temporarily moves sideways or slightly down. This is a pullback. This is a consolidation, pullback, continuation, pullback, continuation. This is the S&P 500 on the daily time frame. And when you spot these bullish continuation candlestick patterns, is a strong indication that buyers are still in control of the market. This gives you the opportunity to enter or add to your positions with greater confidence, knowing that the trend is likely to resume in the same direction. So the thing is, you have to be looking for key bullish continuation candlestick patterns at key areas in pullbacks and be looking to jump into the bullish trend. So there are key candlestick bullish continuation candlestick patterns which you are supposed to be looking for at pullbacks like this, because a trend, basically a bullish trend, is it goes higher high, higher low, which is the pullback, and a higher high and a higher low. And this was a consolidation that created a new higher high. A new higher high here had this higher low, and that's how it just keeps on going, So there are key bullish continuation patterns that you can spot at these pullbacks and or consolidations. So this is what we'll be talking about today. Let's talk about key bullish continuation candlestick patterns that you can use in the market for bullish continuations. So the first on my list is the rising tree methods, which is what is displayed on your screen. I'm going to explain the rising tree methods, and this pattern consists of 5 candles. It starts with a long bullish candle, followed by 3 small bearish candles that remain within the range of the first candle. The pattern ends with another long bullish candle that closes above the high of the first candle. So the fourth candle should close above the high of the first candle. And now you should know that when you spot this pattern, it shows that buyers are still in control of this market, and this bearish candles failing to go below this first bullish candle signals that yes, indeed, we should be looking for bullish continuations. And you can see this next candle, the fourth candle, which is the bullish candle, closing above this high, signaling to us that yes, the bullish trend is still on and we should be looking to enter at this level. Let's quickly hop on the charts and look for key examples where this rising tree methods formed in the market. So the first step in trying to spot a candlestick pattern is by using the market context, checking the market context, performing your normal price action and technical analysis, your key levels, your resistance and support zones. In this case, we are looking for bullish continuation candlestick patterns, so we'll be looking at key support levels in the market. This is a key level, and we are supposed to have this. Oh, sorry about this. let me just reduce the opacity. Right, so this is a key level and we are expected to see some bullish continuations from this area. If you stretch this a little bit backwards, you can see it. This has been a key level. From here, this was resistance turned support, and we are supposed to be expecting bullish continuations from this area, from this support area. Now zooming into, you can see this rising tree methods. We have the first bullish candle, which is this one here. This is the first bullish candle, and we have 3 small bearish candles still in the range of the first bullish candle, and the fourth candle closing above the first candle, both the first candle's high, which is the fourth candle, this one right here, and that is a confirmation to enter a bullish trade. Also, we have the same example here. We have the first candle, which is this bullish candle, and we have 3 small bearish candles within the range of the first candle, and then we have the fourth candle closing above the high of the first candle right here. So this signals a bullish continuation is likely to take place from this support level. So this is how we can use to enter these buy trades from this area of support. Let me look for another example of the rising 3 methods. Remember, this is a bullish continuation candlestick pattern. I think I saw one example here. Okay, this is wonderful. Now, as you can see here, we are bullish. Price has just been giving us a push to the upside. We had a break of this resistance zone, showing that yes, we are clearly bullish, and we should be looking to buy or enter buying positions. And you can see this rising 3 methods right here signaling bullish continuation, and that we should be looking to enter after this brief consolidation right here. Now you can see the first candle, this one is a bullish candle, and we have 3 small bearish candles all within the range of the first candle, and the fourth candle is a massive bullish candle. And you can confirm that candle by using the volume analysis and checking confirming the buying volume around that area to check if it's in line with our analysis. And you can see increasing buying volume around the time we had this candlestick formation. There's an increasing number of buying volume and buying histogram volume bars, as you can see right here. So this is a good confirmation, and we can be looking to enter at the close of this fourth candle. And we have another example here, and as you can see, we had this pullback into this level. There is a support level right here. Had this pullback into this level, and we had the rising 3 methods right here. We have the first candle is the bullish candle, had 3 small candles all within the range of the first candle, and it fails to go below this first candle's low. And then we have the fourth candle closing above the first candle, as you can see right there. So this shows that we should be looking for buying opportunities and for a bullish continuation. And you can see after that, you can see several candles after it, we are all bullish. So that is it for the rising 3 methods. The next bullish continuation candlestick pattern on my list is the upside Tatsuki gap. So the upside Tatsuki gap is a 3 candle pattern that begins with 2 strong bullish candles with a gap between them. Then the third candle is bearish and partially fills the gap but does not close it completely. Then the next candle is the confirmation candle, but it is not entirely part of the candlestick formation. This is just for the confirmation, because once the price closes above this high of the upside Tatsuki gap, it signifies that we should be looking for buying opportunities. So this is just for added confirmation. All right. So as I said, it's a 3 candle pattern that begins with 2 strong bullish candles with a gap between them. This is the gap between the close of this first candle and the open of the next candle, the next bullish candle. and it's expected that the third candle, which is the bearish candle, should come and fill in this gap partially. It shouldn't fill it completely, it should just fill it up partially. And after that, we should expect buying candles or bullish candles after that, closing above this high, above the upside Tatsuki gap pattern. So let's quickly look at the charts. Let's look at one or two examples. We have one very clear example here, and this example is a very perfect example. First, you can see that we are bullish and we should be looking for a bullish continuation. We just broke structure to the upside, and this level, this key level right here, is now support. This was resistance initially, but it is now support, as you can see right here. And you can see price, after the massive break of this level, this key level, we have price retracing to this level to use it as support. So we are looking for buying opportunities or bullish continuation of this trend, the uptrend. So having said that, we know that we are looking for bullish opportunities. You can zoom in and you can see the upside Tatsuki gap. We have two strong bullish candles. Have one here, the first one, then we have the gap. There's a big gap right there, and the second candle, and you can see the third candle failing to close that gap, filling it up partially, and that is a major requirement for the upside Tatsuki gap. And then you have the next couple of candles closing above this, the high of the upside Tatsuki gap, signifying that yes, this is a valid upside Tatsuki gap candlestick pattern, and we should be looking to enter buying trades or buying opportunities. We should be looking to long this trade or long this markets. So you can just quickly enter your buy trades with your stop losses below the low of the first candle, and you'll take profit at a fixed risk to reward ratio of 1:2, or you could just target significant resistance levels. In this case, we are bullish, so you could just use your Fibonacci extensions. You could just use your Fibonacci extensions to know the exact area. Sorry, I think I have to set this. So you could use your Fibonacci extensions to know the exact area where price is gonna get to. I'm just gonna add the 1.61 and the 1 point, right, and also this one. And you can see you could be targeting the 161.8%, or you could target the 127.2%. We have talked about the Fibonacci extensions in our channel. You can just scroll through our videos or search through our videos, and you will see lots of strategies and tools, trading tools, which we've talked about. So you can just go and watch. We've talked about the Fibonacci extension, so you can just go and research on that on our channel. So this is for the upside Tatsuki gap. The next on my list is the separating lines. So the separating lines pattern involves two candles. The first is a bearish candle followed by a bullish candle that opens at or near the same level as the first candle's open, but the second candle moves higher, closing above the previous candle's high. Okay, that's long. Okay, I'm gonna break it down. The first candle should be a bearish candle, and the next candle or the second candle should be a bullish candle that opens very close or nearly identical levels as the first candle's close, but it moves higher. So it should be almost at the same level. Here, the second candle should open almost at the same level with the first candle's close. So this is called the separating lines candlestick pattern. But the second candle should move significantly higher, closing above the previous candle's high. So this is the separating lines candlestick pattern. So let us look at the charts and try to spot the separating lines, the bullish separating lines candlestick pattern. And you can see here it's quite a very popular candlestick pattern in the markets. You can see this bullish trend. Remember, the first step is to look at the general market context. to check where price is coming from and where price is going to, so that we can take proper trade entries in line with the overall market trend. So you can see price is generally bullish, and we just hit the third tap into this trend line, and we're looking to continue the bullish continuation to the upside, and we're expected to break structure and continue this trend. So now we have where price is going to in mind. You can zoom in and spot bullish continuation candlestick patterns. In this case, we are talking about the bullish separating lines, and you can see one sitting pretty right here. And then we have the first candle, which is a bearish candle, followed by the next candle, which is a bullish candle. Now you can see the bullish candle's open is very close to the first candle's open, and you can see this signifies separating lines, a separating lines candlestick pattern, and we should be looking to buy. So this brief pause right here was just for this continuation. This is just building up for the continuation. Remember, the overall target we are targeting is this high to break structure to the upside, because we are bullish, and this was just used, the separating lines was used to tell us that we should be looking for a bullish continuation in this present market at that point in time. So let's look for one more example of the separating lines candlestick pattern. It's a pattern that occurs frequently in the market. So we have another example here, and you can see price had this break of structure, and then we had this pullback into this area. Actually, let's use this one. Had this pullback into this area for the continuation. Now looking at this, you can spot key levels. I like to spot key levels and use key levels to trade. We have one right here that is a key support level, and that we should be expecting price to come back to this support level and give us a push to the upside. And then you can see after that we have several confirmations, price giving us this push to the upside, several candlestick patterns right here, but we are just going to be focusing on the separating lines. And you can see one right here. We have the bearish candle, and we have the bearish candles open, and the next candle, the bullish candles open. They are similar, the open prices are very similar, and then that means this is a separating lines candlestick pattern, and we should be looking to buy. So after the close of the next candle, the second candle, you can look to enter a buy trade with your stop loss just below the low of the separating lines candlestick pattern, and you could just target a 1:2 risk to reward ratio, or you could just target the next major resistance level like this one. This could be your first target, and move your stops to break even, and you can target this one also. Or you could just use the Fibonacci extensions like we discussed earlier. And the next on my list, which is the last, is the side-by-side white lines. So in this case is the green lines, because my chart color the green lines for the bullish candles. So this pattern forms when a tall white candle gaps up to a second white candle with no overlap between the bodies. A third white candle, or green candle in this case, with a similar open to the second candle, indicating continued bullish momentum. So you can see right here we have the first candle which forms, and after the first candle it shows strong buying momentum in the market. After this first candle's formation, we have the next candle open up with a gap. There's a gap here between the first candle's close and the second candle's open, and this signifies that the bullish trend is a strong one. And we have the third candle opening up with similar or nearly identical opening and closing prices with the second candle. So this shows bullish market stability, and it shows that we should be looking for a buying opportunity or a bullish continuation in the present uptrend. So let me just hop on the charts and show you this candlestick pattern real quick. Now we have one right here. So we are bullish, which is the first thing you should know.
You can see this is a major key level which we are reacting from, and then we are looking to break structure to the upside right here. Okay, now after spotting this, you can see we had this leg, had this swing from this swing low to this swing high, and you have price reacting from the 61 point between the 50% and the 61.8% Fibonacci level. So at that point you have the side by side white lines, or in this case the side by side green lines. You have a bullish candle, and you have the second candle is the, it opens up with a gap, and this is the confirmation candle, and the third candle shows stabilization, showing that yes, we are indeed bullish and buyers are taking control, and this is confirmed by the volume. You can see this, there's enough buying volume around this area, showing that the bullish sentiment is stabilizing and enough buyers are entering this market at this point. You can see this is confirmed also by rising buying volume around here. So this shows that yes, we should indeed be looking for buy trade opportunities. At the close of the third candle, you can look to enter your buy trade with your stop losses below the first candle's low, and your take profits at major resistance levels, or you could just target the fixed risk to reward ratio of 1:2. And that is for this example. Let's look at the next example we have here. Remember, we are still bullish, and then we have another candlestick pattern for our bullish continuation, and you can see this. We had the first candle, which is a buy candle, bullish candle, followed by two candles which gapped above the first candle, and they opened and closed at similar prices right here. So at the close of those candles, you can look to enter a buy trade with your stop loss below the first candle. And you can also confirm this with the volume. Remember, you can see increasing buying volume right here. You can see, let me zoom into that. You can see the same time we had this candlestick pattern, there is an increase in buying volume right there, showing that buyers are stepping in. And also same thing happened around here. So it just shows that buyers are stepping in, buyers with deep pockets are stepping into this market, and we should be looking to trade in line with them. And we are bullish also, so you could just target the overall target here, which is a 1:5, but I like to stick with the fixed risk to reward ratio of 1:2. So that is it for the key bullish continuation candlestick patterns. We have covered 4 of them. So how do you trade these bullish continuation patterns? The first things first is to confirm the existing uptrend. Before considering any continuation pattern, ensure that an uptrend is already in place. You can use moving averages or higher highs and higher lows to confirm this. Now the next step is to identify the pattern. Now we've talked about this. You should identify the pattern, look for specific bullish continuation patterns. We discussed this earlier, such as the rising tree methods, the upside Tatsuki gap, or the side by side white lines, or you could also spot the bullish separating lines candlestick pattern. So the next is to wait for the pattern completion. Patience is key. Don't jump in too early. Wait for the pattern to fully form before considering a trade. Now the next thing is to look for confirmation. After the pattern completes, wait for a confirmation candle. This is typically a strong bullish candle that closes above the pattern's high. And you can also consider volume. Increasing volume during the formation of the pattern, and especially on the breakout, can provide additional confirmation of the trend's strength. So after confirming your trades, identifying the pattern, and waiting for the pattern completion and all of that, the next is to set your entry point and manage your risk. We have discussed all of that. You can also use additional technical indicators like the moving averages, the RSI, or the MACD, as these indicators can provide valuable insights into trend strength and momentum. So common mistakes to avoid is ignoring volume analysis. Always use the volume. And also another mistake to avoid is failing to set realistic targets. It's essential to have a clear plan and identify potential price levels where you exit the trade to secure profits. Without a well-defined target, you might hold on to a position for too long, hoping for even higher gains, only to see that the price reverses and erase all your profits. So the next mistake to avoid is neglecting risk management. Traders often get carried away by the excitement of a pattern and fail to set appropriate stop loss orders. Your stop loss order should be below the pattern's low, as you can see in all our examples, and always set a stop loss to limit your potential losses if the pattern fails. So that is all for this video. By now you should have a solid understanding of the key bullish continuation candlestick patterns and how to trade them effectively. If you found this video helpful, don't forget to like the video, subscribe to the channel, and turn on the notification bell so you never miss an update. Thanks for watching and happy trading. Till next time.